You showed at the end actually that Europe's fiscal position, perhaps of the US deficit is manageable.
അതൊന്നും
So
അവർ
we have
കസേര
our
ഇങ്ങോട്ട്
survey
വെച്ചിട്ട്
of
അവർക്ക് പെണ്ണുള്ള കസേര ഇങ്ങോട്ട് വെച്ചിട്ട്
concern about budgets. Tell us a little bit more about the new fiscal framework. Just touched on it, but what are the target debt-to-GDP ratios? How will they be enforced? And how will the consultation process
Maybe first, you all can hear me well? Yes, not too loud, all right. Maybe first a comment. I mean, obviously, there are a number of member states in the EU where the debt levels are pretty high. It's important to stress that those countries are actually the one who are most aware of the opportunity cost of high levels of debt. So they are also the most aware of the attention that also you guys and capital markets are playing to that. So in that sense, they are strong advocates of having a workable and realistic anchor at the European level that helps them to manage this. Now, the key features in our reform rules are to make them more realistic, in the sense that you cannot, control and you cannot correct a high level of debt from one year to the other. It has to be economically realistic, and high levels of debt in countries that have also suffered from relatively low productivity growth in the past have to complement their fiscal strategies with reforms. Now we have a good combination. We did talk a lot about the RF so far, but this recovery plans are underpinned by quite ambitious and comprehensive supply side reforms in member states, which should also help over time to actually address exactly these productivity elements. So now the key features here, member states need to submit to the Commission and to the Council a 4 years, so medium-term fiscal strategy for the consolidation. The point of departure for that is an expenditure trajectory that the Commission is calculating on the basis of the debt challenges in countries, so there's a debt sustainability analysis underpinning all that. The plans have to comply with this adjustment. But it's clear that it's not within 4 years that the debt will be corrected. But what's clear is that the plan has to demonstrate that over the medium term, debt is put on a downward trajectory that's acceptable.
Thank you. Thank you, Ryan. Perhaps to explore that in a bit more detail. I think you'll find the chart actually in the context of elsewhere, it looks manageable. To introduce my other panelists, Elliot Hentoff, who's head of macro policy research for State Speaker Advisors, and Patrick Bard, who's head of European fixed income. Thank you very much for joining. Elliot, I wanted to stay on fiscal for a moment. I was struck by the chart that Ryan Archer showed, which compared the impact of the GFC on the European economy with the recovery from COVID. And it seems to me that Europe has somehow managed to avoid the sin of austerity, which in my country still has an effect, while also keeping an eye on debt sustainability we just talked about. Do you think that's right?
Let me take a couple of markets quickly. Europe is really a very different place for global investors than it was for one and a half decades. And I think we really have to just pause and really acknowledge how different it is. Some of it might not have.
Tell us all about it.
The fiscal story is part of it. First of all, Europe suddenly offers zero again, which it didn't for a very, very long time. That was one of the reasons why capital had left Europe and is now one magnet that's returning. Obviously, the fiscal profile that underpins debt issuance is critical for relative appeal, and I'm sure you'll have more to say on that. The other thing on fiscal, though, that really matters. What was one of the problems of fiscal post-GFC was obviously you had a Eurozone, sovereign debt crisis, you had a constant perennial worry about disintegration of the Eurozone. That tail risk has shrunk enormously. So therefore you're basically getting, just as a starting point in the 2020s, in case Europe offers yield, and the idea that you'll have this tail risk, the disintegration of the monetary union is quite remote. And so that's already very different story. So now the discussion around fiscal can be much more technical, and I'll leave the fixed income specialists to elaborate, where the technicals make it relatively appealing or not.
In terms of the clientele of securities advisors, it's not primarily your job to market to them. But would you say that there's been as we're finding, a renewed interest in euro-denominated assets outside the eurozone?
No question. I think both for equities and bonds. I think again on bonds we did hear about the growth of the EU as an issuer itself. It's obviously public debate. It's very exciting. But there is a scarcity of safe assets generally in global markets, and so there's that scarcity. There's the excess demand for that. So there's ample place for issuance to grow well beyond where we've been in the past. For equities, the story has really been around, everybody, probably most people in this room, as investors, overweight US for obvious reasons, overweight US large cap in particular. And as this search again, we would like more diversification. My role, the number one question I got in 2022 after the war in Ukraine was, Europe, is it time to buy Europe? This looks like it's a dip, it's an opportunity to step in. Some of that has happened. By and large, the deterrents have been low growth, structurally low growth, low productivity growth, and then combined with some of the structural geopolitical and macro headwinds. They do look like they are receding, and some of the resilience that I spoke about is starting to be convincing, particularly on the energy side.
Okay, well, and I'd like to come back to the euro as a reserve currency in a minute. I know it's something that we've talked about before. That's an interesting evolution. Patrick, on your side, we're going to go into the technicalities in more detail later regarding the issuance of the commission. But would you agree that the euro fixed income markets have been fundamentally changed by the emergence of the European Commission as a major issue in its own right?
Yes, of course, because it's showing the coordination of the policies. And I would like just to highlight that we have a global view. When you're a portfolio manager, you analyze the things not only in absolute terms but in relative terms. And I listened to comments before. What I would like I work for a US company. So what is interesting today is that the public expense is now popular everywhere. In UK, in the US, not only in Europe, because there are changes. And my first remark is that the changes concern the activity. There are social challenges, there are political challenges, and more domestic activity. Because when I listen to your comments today, don't forget that we like to have more growth, more activity, more production locally. That's the consequence of the crisis, if you can say something. So on this opportunity, the European Union as an issuer is important to fund all the long-term plans. And that's something we have to play for years. And of course, that's a question for the market to do it. But again, what is important for the markets is to analyze the long-term figures. We spoke about the level of the debt, or the deficit, but finally, the activities there. For me, the political commitment of the European Commission and governments of the Eurozone led to something new. The growth is supported in Europe today by the South. The highest activity is in Spain, for example, and the North is facing an industrial challenge. The north of Europe, in Germany, in the Netherlands, the industry was so strong. And it was become the energy stabilized, the price of energy stabilized, but it's still higher than it was. So the industry in Europe was supported by cheap energy coming from Russia. And so we can't expect that anymore. So we have to have a long-term project to switch to something. That's a part of the discussion today. And Europe, I don't say there are uncontrolled public expense. Yes, it depends on the country. I agree that France, I know, perhaps too much social expense, but it's a political question also. But on the long run, what is important is to have higher activity for the decade. If you summarize what happened up to the COVID-19, the South had no growth. In France, it was very average, only the North had growth. And today, we would like to have, I would like to say, a more balanced activity. Yes, it's more and more service, so less funding, but we should have, in addition to the service sector, all the IT system, all the electricity, energy. So there are many things to be think. We have to rethink many things, as you know, and that's not the private sector, that's the public debt. And I think the market is looking for the trend. Yes, the public deficit are still high, but this is the case in USA, in UK. And secondly, the trend is less public expense. The deficit was higher, for example, in France, Italy. It was more because the revenue, the fiscal revenues, fell quicker than the public expense.
Do you think?
We understand the difference.
Yes. Do you think then that the crises, both Ukraine and COVID, have left a helpful imprint in the sense that it's changed the balance between North and Southern Europe, which was pretty strange to the extent of monetary union, and now that's somewhat been solved also with the help of NGEU.
I fully agree. It's not the Ukraine invasion itself, but all the consequences.
Second-order effects.
It means many factories, industrial companies used to produce in the east of Europe.
Yeah.
And perhaps we would like to have less exposure to east of Europe. Not because of the Ukraine itself, but because of the energy source. You know, the distribution policy was the key issue for Europe compared to USA, compared to other areas. And of course, the companies are more looking now to produce locally where they are selling goods. That's something very new.
You'd like to come in there. I'd like to ask also about the fundamental growth model in Europe as well. Come to that too.
But I wanted to briefly come in on Dave's question and what we discussed just with Patrick. I think that we like to make 2 points. The first one, the COVID shock was very different in nature compared to what was perceived was the reason of the financial crisis.
Right.
And it came like a natural disaster, and so there was no, value judgments attached to it. And it was very clear, and very quickly clear, that collective action was needed. And I think this is very important to keep in mind, and actually Europe showed enormous solidarity. So that was on the political side, I think it's very important. The second is there was a strong consensus to basically follow the objective to build back better. And if, as we have done, mobilize 700 whatever exactly it is, billion of public money, it was clear that this has to be invested in modernizing the European economies with a view to improve their level of activity. And this is actually what we're seeing, and it's a clear trend. I mean, more than 40% of the funds are actually earmarked for energy efficiency and climate-related aspects. More than 20% of the financing, in some countries, significantly more, is going to accelerate the digitalization. Following the attacks of the war, an additional chapter has been added to address exactly the energy sector, to accelerate permission, and to ramp up and accelerate the increase of capacity of renewable energy.
In a sense, it was useful in chronological terms that in the UK before the Ukraine war, I suppose, it's helping with the after effects of that in terms of the energy.
In many ways, yes. I mean, when the war erupted, it was very quickly clear that we have a framework in place that's solid, that has a governance structure that's accepted, that has been, still growing and learning by doing in a number of countries, but that was robust to be used. So we didn't need anything new. Now, to your question about the growth model, I mean, we're clearly having a new discussion of competitiveness, which in essence is about improving productivity.
Right.
And we know that there are important challenges in this climate transformation that we're in. And the double challenge is that, of course, this is a global imperative, is that this has to be a transformation towards decarbonization. So that orientation, that objective of travel is very clear. And I think actually the combination of the tensions and challenges coming from the geopolitical area, together with this imperative of decarbonization, is now fueling a very strong discussions in Europe how this new competitiveness agenda will look like. And I think this is there is also work for the new Commission, the new legislation here to be done. But this is exactly where the growth model is rooted.
You may not have you modelled out the economic impact of eventually much cheaper energy if the renewables revolution is completed in a successful way, partly thanks to the investments that you do?
Now, okay, let me separate that.
Yes.
What we did model indeed ex ante is the growth implications of the AGU and the implementation of the plans.
Yes.
We've done that in the Commission, looking only at the investment side, where we basically leverage speed and investment growth, the GDP growth added around 1.2% for a number of countries. So there's envelopes for member states are different with those countries most in need and higher access to financing. There the growth impacts are more important. What's important to know for Europe is that the fact that all this is happening in a synchronized way is actually producing a lot of spillover. So even countries that have less funding are benefiting quite a lot. Our colleagues from the ECB also did a heroic modeling the implications of reforms. It's always hard to really see them down, but they also can see that there was additional elements. Now, your concrete question about what would be the growth impact of lower energy prices. I mean, I'm not aware of models of this, and to have to be frank, there's still a bit of way to go. But it's clear, I think now, Europe is already producing more than 50% of its electricity with renewables. The marginal cost of energy production for renewables are close to zero. So there is enormous potential. And the last word is indeed there's a shift in geography of the growth momentum going on. Because there are probably different comparative advantages in different countries when it comes, for instance, to the production of solar energy or hydrogen in some countries. So one important element is to also make sure that the infrastructure is there, that electricity can travel to places of production.
Thank you. Elliot, we can't do a macro panel without talking about inflation and interest rates. So let's spend some time on that. We saw Reinhardt's chart what looks like a reassuring normalization of monetary policy after an extraordinary period. I said earlier that perhaps it's almost been helpful that the crisis allowed central banks to get out of the quantitative easing trap, perhaps, and to head back to something like 2% rates, growth, inflation, and so on. Tell me what your take is on the normalization of monetary policy and growth rates in Europe, in much as you forecast.
Very, very short term. Very short term, things have really improved. I mean, really short term. Looking at the second quarter, looking at the third quarter for this year, we do see disinflation story in Europe. At least is very much on track. It's not like in the US where we've had a little bit of some doubts about the future trajectory. In Europe, it's very much on track. So that should give a lot of comfort to central bankers. In Europe, normalization of monetary policy, the beauty here is that even though inflation is coming down and we still have quite a bit of growth headwinds, we think the worst is behind Europe. So for the coming months, there's a little bit of a Goldilocks story here where growth is actually picking up, inflation is coming down. Now, I don't want to ruin this party here because I know we've heard a lot of great things about Europe, but that's a very short term and let's not exaggerate that dimension. And actually, even in Europe, you're going to get steeper inflation, probably closer to target than in the US. Look, it's the growth question, which is really the big one. I think I want to, maybe I'm throwing a spanner in your plans here, John, but I do want to, in many ways, to hear what Ryan has spoken about, Patrick. If you think about Europe, internally things look better. A lot of the shock resilience, there's more cohesion, a lot of big boost in public capex. We've spoken a lot about NGU, but there's also going to be on the defense sector a big shift in public expenditures, which has high fiscal multipliers. Overall, tends to have nice positive macro externalities across the board. At the same time, while the internal story is much better, the external environment is so much worse and deteriorating. Let's not kid ourselves. It's not getting better. Particularly, not only the geopolitical risks explicitly on the trade front. I heard mention, there'll be some trade normalization soon. I'm not so sure whether there'll be trade normalization. It's quite the contrary. I think some of your colleagues are actually considering trade intervention or that policy measures to basically address some of the imbalances, global imbalances, and some of the uncompetitiveness measures of the European
You're talking about subsidized Chinese cars in Europe, for example, in the European market.
And the problem is the external environment is unfortunately key to lifting Europe's growth prospects. And so there, I think also a lot of investors continue to harbor big doubts around whether you could actually see serious momentum and a return to kind of 2% growth levels over a long period of time. I think there's a lot of doubts, and the doubts are justified. And I also would like to hear my colleagues on the panel here a little bit more about to what degree the belief in higher growth is possible. And again, internally, the story is very sound. Boosting public capex, the right things are being done, cohesion, and so forth. Externally, I'm not so sure.
Patrick?
Well, I share your cautious analysis. I think we have two remarks first. The first one, as we discussed already, the public expense was quite important for activity everywhere, especially last year. And of course, it's due to what you just explained. And the public expense started to diminish.
It would be nice to do a fiscal expansion and reduce inflation at the same time somehow.
Yeah. And that's the challenge for the central bank, how to conclude on that. But to be clear, for Europe, the public expenses started to decline. So there are less support for the activity. Secondly, the second remark is about the importance of the central bank in terms of policy, because if you remember all the analysis years ago, we were expecting a role of debt reimbursement in the Eurozone, especially for highly sector this year and next year. If you remember, and the question was the refunding of the activity, which was, of course, not easy when the yields are higher, and then the spread was should widen. It didn't happen because of the central bank policy, because finally the liquidity is still there. And a part of the activity we benefited in most countries is due to the liquidity excess. And what is important is that the central bank didn't move. We can say there are less liquidity, but it's more due to the targeted LTRO funding in the Eurozone.
The withdrawal of ECB from quantitative easing very gently, so that it hasn't had the difficult consequences that some people predicted.
Exactly.
Why not, do you think? Is that because of the fiscal side of the equation, or people are just unduly worried about the solid financing costs?
Well, I think this was supported also by the banking system.
Right.
If you remember what happened for a decade, we had, especially in the south of Europe, weakness of the banking system. And that's something we spoke about the activity growth. On the opposite side, you don't expect any issue. Because the banking system is well managed, well capitalized, perhaps less profitable than somewhere, for example in the US, and then the issue should be more of a idiosyncratic risk, what I call the zombie company. Because if you understand well, when GCP exited from the negative rates, it was very quick, and the consequences were very low.
Yes.
Because governments supported. Including corporates, if you remember. Many governments supported the corporates in the Eurozone with different ways, as you know, and now it's the activity, and that's your comment. The question is that in the Eurozone, the margin, the profit are lower than they are in the US. For example, for the first quarter of this year, we expect year-on-year a decline by 10 to 15% for corporate.
You all seem to say there's a bit of work for the private sector to do in the coming years ahead. In Europe, I think. Everyone would like to ask a question, please raise your hand. You'd be very welcome to ask the panel questions and I want to come on to currency. Clive, please.
Yes, I'll just wait for the microphone just so I don't project too much. Thank you. Hello everyone, Clive Hall from OMFIP. Picking up on something Patrick said, I wanted to ask Reinhard the extent to which there is now more synchronisation between the different economies within Europe, both in terms of inflation, GDP outlook, levels of public debt and so forth. And then to Patrick and Elliot, if there is, and even if there isn't, to what extent should global investors be thinking, well, the EU bonds offer me a chance to buy the whole of the EU rather than I'm necessarily going to sort of like choose between France and Germany. Effectively, that the EU bonds may in some ways be almost like an ETF of European sovereigns rather than picking the individual stocks within the EU, whether it's France, Germany, Spain, or whatever. So Reinhard first, please, on the synchronisation of the continued divergence between the economies, then maybe Patrick and Elliot on that idea of a EU bond ETF almost.
Interesting, thank you, Clive. Yes, on the convergence of the European economy, we talked about the pressures in monetary union before the crisis. Perhaps they've somehow been helped, as you said. Tell us about the divergent convergence of European national economies. I think it's interesting to hear more.
No, many thanks, Clive, for this question. Let me take first a bit of a longer-term perspective of that. Obviously, the divergence of the economies and also the growth models 50 years ago were one of the main concerns and main reasons for the troubles that we had before that. And I mean, all the way to the question of the countries would be the union. This is long gone. And the countries that were under stress at that time did, it's a small word, did their homework, but actually, embraced quite important reforms. And since then, if you look at the growth rates, they've performed significantly better than the EU area average. And so we have, since then, basically a medium-term trend towards convergence. Now, obviously, the energy price shock brought, with a completely different geography, new asymmetric implications across EU member states. As I hinted during my presentation, particularly Eastern European countries, where the overall competition and also the energy intensity of production was higher, they were hit much deeper. So the recession was deeper, or the economic slowdown, where there was no recession. The inflation explosion was much higher and also more protracted. Now, what we see in our forecast and looking ahead, this is actually mending. We are doing regularly also what we call in-depth reviews of the macroeconomic imbalances, and here we see a trend moving into a good direction. When it comes to the fiscal situations across countries continue to be very adverse. And this is what I said, and I think what I like about these new fiscal rules, the reform, is that this is firmly acknowledged by everybody, that different starting positions, different economic conditions across countries require also a different approach in terms of dealing with those. But it takes time. I mean, debt levels are stocks, so they do not come down so quickly. But as I said, the awareness in those countries where debt levels are well above 100%, that they have to do something about that. That is clearly there. And then we have seen over the past year and a half when negotiating these new set of rules.
Thank you. I'd like also to come back later on to the internal dynamics of the single market, banking union, and capital market union and so on. Absolutely. I think that's a little bit. Elliot, this interesting point that Clive raised that you can almost get an ETF of European sovereigns through NGEU. What do you think about this idea?
Well, in capital markets, we've been longing for this for many years. In the middle of the last decade, colleagues from us will remember this. We were consulted also as a firm how to construct this convoluted set of ESP, I forgot what it's looked for. But basically, to build a collateralized debt obligation through basically the individual ingredients of your Eurozone sovereigns. And obviously, the only reason these complicated technical consultations took place in the first place was because there was no political will to issue at the EU level. And that's one of the nice side effects of multiple shocks and crises is that politics shifts, the Overton window shifts, and now you actually have it. So it's basically been something the market has asked for a very long time. And as a matter of fact, Patrick can probably speak more to this, I think having a little bit more confidence over the long term that this issuance program will be persistent, that it will be kind of almost a curve that gets built, that the market can rely on, a regularity, all that is very much desirable. And frankly, I think would be very helpful just because it, again, from a global capital perspective, would allow for regular capital inflows to the Eurozone and also anchor the shift a little bit to that.
Would you expect that, and we'll talk a little bit about this with the Commissioner of the course of the day, the NGU has got a time limit to it, albeit it will be refinancing for a very long time and it's significant amounts, as we will hear. Would you expect, Elliot, that it may, just as a pundit, that it may persist in some form beyond the time limit at NGU?
Public institutions, bureaucracies are very hard to die. They're immortal in many ways. Once you create something, it's very hard to end it. And frankly, I do think if perhaps the name of the brand will change, but I do think they will be with us for a
It's
very
quite
long
a
time.
useful thing, albeit there are lots of political obstacles to it carrying on, but capital markets anyway would welcome its continuation.
And let's be very frank, Europe has a structural growth issue. If it's not NGEU, there's other space and needs for public intervention to boost productivity, to address economic weakness. So I could imagine a variety of ways of how this gets redesigned and rebranded.
Yeah, exactly. Patrick, would you agree? I remember in France there was a portion of the government debt called CARDES that managed to outlive its deadline, I think. Might you expect that NGEU would do the same thing?
Well, I would like to just to respond to different comments. At the beginning, when the NGEU was launched, the market was skeptical. If you remember, the economic forecast didn't include, I think, what we could take advantage of that program.
It built incredibly quickly and has done.
Because you remember the history of the euro, we spoke about the administration timing, which is not the one of the market and the activity too. I would like just to make a remark. It depends on the countries. Of course, and finally some countries did well. It's late compared to what was expected, for example, in Italy, but finally the expenses are there. It's taking more time, but of course there are conditionality. You can't send the money just like that. And of course, when you have a global picture, I would just highlight that the global picture means when you have a single currency, no government debt could represent the currency, as it is in UK and the US. So the book is too small in terms of outstanding amount, and you don't expect the book to issue to represent all the savings, all the activity of the Eurozone. And that's a safe debt. So the EU was acting needed for that reason. And then to organize what we can say the euro ID. Because when you spoke about yield, which yield do you consider? I'm working with American, so do you consider the good yield? That's the usual discussion internally. The French yield, which is perhaps the best representative of the Eurozone in terms of risk, in terms of liquidity, or do you consider one day the EU yield? So you understand my remark?
And what would be your answer?
Of course, the best should be
Yes.
of course, because it makes sense also for the coordination.
Yeah.
If you have public expenses, more and more budget should be common.
Yeah.
For example, the next one, I don't have any information, but should be the military effort, which should be managed globally. Of course, the productivity is something more difficult because each country is different in terms of sectors, in terms of expertise. And of course, we spoke about the infrastructure of the Eurozone, because the issue when you produce electricity with wind or solar somewhere, you don't have the infrastructure to send the electricity to other countries. There are many projects like that, so the activity is linked per country. I know it's complex, but finally, when you look for the global picture, you can see it's working well. And what was the main issue behind all the figures, I saw your remarks at the beginning, I think the issue for the Eurozone was more unemployment rate, which was very high compared to other countries, developed countries, and that's a political question.
It is. Elliot, sorry, just to explore the point a little bit more, Elliot, from Patrick. I'm not going to ask the Commission this because it's not reasonable for me to do so, but can you imagine NGEU as a European DMO in Genesis?
Look, I think that's the hope. The hope is, look, the integrations. The European story for the last 50 years is just one of gradual integration steps towards more integration and cohesion. I think we're still very far away from that vision. But I think that is the path. But I think that's a story. If you told me 2050, maybe, but it's a very long term. I do want to hark back to something because the glass is kind of half full, half empty here. Europe has fiscal space. There's worries about public debt levels, debt levels.
Especially to the chart I'm sure earlier relative to the US, for example.
There's no question about it. The question is how is it used. The problem with Europe has always been not the numerator but the denominator.
Right.
It's all about growth and whether the deployment of public funds actually supports the denominator and the growth of GDP. Right. And that's really the. I think next year markets will increasingly turn to the US fiscal picture as an investment story. As US growth starts to weaken and obviously post-election the fiscal profiles. From our own calculations, the US has to at least consolidate by about 2.5%,
Right.
3%, just to kind of get back to close to a sustainable or credible fiscal path. That's quite a bit of consolidation. We actually do not see any need for consolidation in the European story if growth can return to trend.
Right.
We actually think, frankly, while we think there's an improvement, we definitely welcome the new fiscal guidelines. We think they're better than the older ones. They still have a little bit of ballast and bias towards consolidation, and perhaps the focus should continue to be on.
Right, there's a Schulden friend or accounting lurking in the background. I think you're saying from specifically the revised point of view, don't worry too much about the fiscal side, think about the supply side reforms that might increase productivity, I think is what you're saying. It sounds like the Commission is doing that. Any other questions? Sir, please. Yeah. Thank you. Your Excellency. Yes.
Thank you. My question is addressed to probably Elliot or Patrick, and it's a question of more of a credit analyst question. So it's really theoretical, but just for me to better understand this, the mechanics of this new asset class. So the underlying solvency of the bonds, of the EU bonds, are probably related to the solvency of the underlying members at the end of the day. So my question is, if I'm to compare or to assess the solvency of the bonds by comparing the conventional metrics that we use to single country issues, and they are mainly probably outstanding debt divided by GDP. So the first part of my question, what's the rule of thumb metric one can apply to this bond, just to roughly assess how active the EU is issuing this bond? And the second is, what kind of headroom does the EU have to issue more bonds without impacting the solvency of the member countries? Take Germany, for instance, which has a relatively high outstanding debt to GDP. Is there any correlation between the two?
Do you want to take that? Essentially, it would be a question for a rating agency to an extent, but how are you regarding the assessing the credit worthiness and the room for credit for the bond?
The fundamental question and the technical question, and then the central answers. As you mentioned in your question, the GDP market share explained the commitment of each government. What was important, of course, was to respect the rules. If each government respects the rules, it's finally going to be the case of the European Union. And European Union, the technical question for me is about what are their expenses. They are controlled by the Parliament, the European Commission. It's about dedicated for long-term projects. There is no social, people to voters asking for something for the European Union. It's for, in addition to the government needs, what the European Union is going to do is to manage long-term projects. And the question was not for the expense, but for me, as a technical expert on debt quality, it was more for revenues. What is the European Union to get its own taxes, its own revenues, which was finally, because today it's easy, the bonds are issued on the long term, or long horizon. So when you like to consider the credit quality, how could you repay your debt? Because you get fiscal revenues. So the question was for the part of the government tax collection to be sent to the European Union or to create new taxes at the European level. So that's the main question today. I don't have the answer yet, but of course, we expect that if we have a long-term project, this project should bring revenues and should help to have some cash to pay the debt.
Ryan, I think we're going to hear about this in more detail as well later from Siegfried and others. But tell us a little bit about the EU's recourse to need to repay these bonds. It's as we heard already, covered by treaty. I think the EU now has the right to create own resources, as Patrick has mentioned, but also, of course, it can call on the national members to service this debt. Tell us a little bit more about these mechanisms.
Actually, I think we have better experts in the room to respond to that question.
Yes, sure. We'll talk about that. We'll talk about that in the next session. Any thoughts, Ruben?
But maybe just one remark, because obviously Patrick is right. I mean, the big change of the game would be to introduce meaningful own resources for the European Union. Now, this is a political aspiration. It's really also an area where the Commission is working on to identify first proposals. To some extent, I think now here I'm speaking to my personal view as an economist. It's a no-brainer. A large part of the corporate sector is hugely benefiting from the integrated single market, from the infrastructure that is provided, and so on. So in that sense, the economic basis for introducing some sort of taxation, I think is clearly there. But politically, the avenue is still pretty bumpy to see.
And if I can say something, the political agenda is driven by elections. So,
Which we have shortly.
yes, so we expect after the election, perhaps more information and not the
But the theory of own resources was already raised, wasn't it, at the time that EGB was set up?
Yeah.
Elliot, how would you regard how would you start to think about the creditworthiness of the European Union, either as itself or as its constituent parts? We're going to cover this more later, of course.
It is a ratings agency question. I used to rate European sovereigns, so I should. But back then, Europe was quite different in its architecture. What I would say is until you start to get questions around the rating outlook, there's actually quite a bit of growth you can still expect in terms of the debt burden that the EU could take on. Typically, in the EU, maybe correct me if I'm wrong, if anything has changed, the member state contribution or obligations to the EU supersedes or is equal to other obligations that they would have. And so therefore it would be very hard for a member state to basically pay all their other bills first and then leave whatever residual for the EU. It's the other way around. So those payments take priority. So therefore the creditworthiness of the joint obligation typically should enjoy a bit of a credit uplift vis-a-vis the individual component parts. The second thing is that the individual components, aside from Italy and a few others, by and large, again, there is fiscal space. The credit outlook is pretty stable, and actually it's improving in a lot of peripheral countries right now. It's one of the positive stories in Europe, and again, I'm trying to balance this panel here with not too much enthusiasm because there's a lot of worries we have, particularly, actually, frankly, most investors when they talk to me about Europe and European sovereigns as a risk hedge, as a how to position for geopolitical downside. But that's another story. So the credit story itself is actually, I'd say, there's more benefit of doubt than anything else.
And I think the agency is AAA apart from non-agency. They answer that question related to just briefly on that point, Elliot, compared with other jurisdictions, Connor's often talk about the ugly competition. The currencies, I want to come back to Euro in a minute. But I've heard in our sessions with you on the US economy that people are worried about, say, some repricing of American risk if there is this budget consolidation that we're talking about. How does State Street advisors think about that? Europe may have a growth problem, but there seems to be a fiscal headache coming potentially in the US, which may change the pricing of American government bonds and therefore everything else potentially.
Well, again, short term, the dollar is king. It's very hard to make the argument for any type of unwinding of the dollar strength, at least for this calendar year.
Right.
Next year, there is obviously an expectation that at some point the growth in yield differentials will narrow and therefore the relative attractiveness of other currencies will rise.
A function of interest rate differentials is in the different inflation paths.
And also the growth paths.
Yeah.
We obviously have Europe recovering a little bit. We expect the US to slow down. So that should balance it. But that's a maybe, and uncertainty. Frankly, there's a risk of the dollar overshoot. Profound. I think it's an underappreciated risk in the markets right now that if the Republicans overperform at the ballot box in November, you could have a real dollar overshoot because this would have more fiscal expansion on the back of where the deficit levels are right now. And that would obviously mean rates stay higher for longer in the US, that they're widening the term premium. That would suck in more capital into the US. You basically get the dollar. That would be a very unhealthy global development, not only for the US, not only for most of its assets, but for the economies globally. So more dollar strength is something is actually the risk that we're more worried about. Structurally, there should be a gradual dollar weakening because a lot of this US exceptionalism is not fully built on sustainable purpose, unless you think there's a productivity miracle.
We've found in our reserve survey we're going to issue shortly the increasing rise of US dollar remains by far the most dominant currency, and everyone expects that to remain broadly the same after the decline in their armies. However, we've certainly detected, not just for technical reasons on interest rates, but geopolitical worries. The sanctioning of the reserves of the Russian central bank and so on has caused some central banks to wonder it might happen to them. Where do you see the euro as a reserve currency, not just in terms of monetary union and Brits, but as in this complicated geopolitical environment?
Well, again, the markets, not only central bankers generally, would love more alternative safe assets. Like the scheme of the scarcity of safe assets, particularly if you think that the core safe asset has some fiscal weaknesses and some concerns. The decline in the euro use of reserve assets was simply a function of the sovereign debt crisis last year and last decade.
Yeah.
The
It's about 20%, dipped a bit and has come back to 20%.
Yeah, so we would expect it to recover back to closer to 25, so just as a natural function. The big lesson in 2022, really, for reserve managers in geopolitically adversarial countries vis-a-vis the US is that it's not the US dollar is not the US dollar, it's the NATO dollar. It's reserve diversification that the Russians did. They did diversify to other G10 currencies in addition to gold and renminbi. That diversification proved absolutely futile in the crisis.
Yeah, we've seen renminbi allocation, we've seen actually go slightly backwards this year in our survey, interestingly. Just while we're on that, what's the state's view on the Chinese economy? We get 5% plus numbers, no one knows if they're quite real, they might be. What's your view?
If you thought I was not enthusiastic about Europe, it was just wait till I talk about China. The short term is we basically have an orderly decline in trend growth in China. So this year looks still relatively robust. There, if we're talking about the growth model and problems, we see very profound existential problems for maintaining catch-up levels of trend growth. We see them declining, and not obviously still in excess of developed countries, but with a differential that's no longer that. Would suggest that in terms of nominal terms, China is no longer narrowing the gap to developed markets for the US.
Right. And would you expect the European countries that do a lot of business with China to find other sources of demand?
I think that's one of the problems I alluded to before. The external environment is worse. It's hard to see where these new sources of demand will come from. We are expecting that EU-China trade relations deteriorate quite a bit, and that will be an additional headwind to that external demand for European goods.
Patrick, just on the current, the fate of the euro, 10 years ago, people were talking about North Euro, South Euro, and so on. That seems a very long way behind us now. On top of that, we've had an interesting test case of the United Kingdom leaving the European Union with economic headaches to come with that. What's the new government view on currency as a reserve account, but also its medium-term prospects?
Well, the short-term trend, the current one is, I agree with our colleague, specifically, we see it a lot of the dollar, because the dollar is the currency of growth. And of course, there is no question today, the US economy is strong. Nevertheless, we think that the euro currency should benefit in the future of the attractiveness in terms of real yields. Real yield, it means the nominal yield minus inflation expectation. And if you come back to the monetary policy, what was explained by the European Commission, in fact, the long-term inflation are reduced by the capital expenditure. The issue of the Eurozone was not the strong demand, but the lack of offer due to the disruption. And if you produce more locally, more in the Eurozone itself, you should have less sensitivity to the global inflation. A large part of inflation, most of all the inflation in the Eurozone was due to the global situation, etc. So it means the real yield in the Eurozone should be more attractive. And then, if you are a long-term investor looking for your currency exposure, real yields make sense. Compared to the USA, you have more growth but more inflation, And there are many uncertainties about inflation evolution in the USA, which is not the case in the Eurozone. We are going to converge to 2%. Below the ECB target, it's more a question of time. Yes, we should have some question about wage increase, but it's less compared to the US. It's more public sector entities. Globally speaking, it's going to back. So for euro in this currency, we expect French are always thinking about the too strong currency.
Right.
Because we have an era of savings.
Yeah.
And of course, the current account was negative during the time of the energy crisis. It's back to something around zero or slightly positive recently because of energy costs. So we have an era of surplus.
Yes.
So the trend should be back after the current trend of the dollar.
Yeah. Okay. Reinhard, on the currency itself, as you heard from Patrick, it's a nuisance for it to appreciate because that's not going to help export growth. Nevertheless, the currency has found its feet, not least in these complicated geopolitical environments. How do you see the further development of the structure of the euro and its importance as a global unit of account?
Your question is about also the larger the euro area.
Yes.
Now, look, my series of slides was already too long. I had a slide that shows the long-term evolution of support for the euro in the EU. And it has been at record levels over the past 3 or 4 years. It's pretty stable. And this question that was there 15 years ago is really behind us. And we have a number of countries that are quite keen. We'll start introducing Bulgaria as the next one. We're issuing towards the end of June.
Croatia's got one, I think.
Croatia joined last year. We have the convergence report coming up end of June, where we every 2 years are assessing the conversion criteria of countries who want to join. They are very keen, they're very close to preparing. We have Romania who's there. We have also a different geopolitical situation in the east. So Poland and Czechia for many years were pushing this far away, and central banks were pushing this far away. The discussion of those countries internally is also changing in the context of the geopolitical tensions. And you also have some discussions in Sweden and Denmark. So what we had in the past, the split when the UK was still there between the euro area as the euro area being different. I think in perspective, this is coming increasingly.
A very long-term convergence of the currency. Very interesting. Anyone got a last question for the panel? You'd be very welcome to put one in. Yes. Michael.
Michael Owen from HSBC. Thanks very much for a really interesting panel and a really good discussion. I think the point regarding the physical headroom in Europe is noted, but to what extent, particularly addressing Reinhard already, do you see risks to the fiscal position from increased defence expenditure in Europe, particularly depending on what happens in November in the US? And maybe can you say a bit about how that's taken into account in the new fiscal framework in terms of missing additional flexibilities there?
Thank you, Mike. I know that Commissioner Hahn may talk about this a bit more later. The key question is defence expenditure was likely to come out for us.
Yeah, no, it's Michael for this very good question. I mean, let's be very frank. I mean, the challenges of public finances in Europe, and not only in Europe, have increased significantly. This is related to the needs of decarbonization and how to finance this. This is, by the way, where we could also speak about capital market union and how to mobilize the private capital. There is we've gotten used to public expenditure over the past 4 years to cover all problems, which is obviously not sustainable, which has to be reined in. We have important demographic trends that need to be addressed. And defense is clearly an additional element. And we do see significant increases already now, and also commitments in a number of countries. Now, our fiscal rules are taking this into account. It is very clear on different levels. So one possibility, I didn't mention that, our rules allow for an extension, so calibration of the adjustment paths, depending on reforms or investment. They also include increases of investment spending, defense spending. So you can remodulate your configuration path in light of that. We also have, now this is getting a bit for connoisseurs, we have to correct excessive deficits where they're very high, and this is something that will come online in the course of this year. Also the possibility to address defense spending as a so-called relevant factor that would also allow to modulate the calculation of the excess deficit.
Sounds like there might be a particular carve-out,
Yes, it's an excellent process.
Yes, could be very helpful. Actually, of course, we'll talk about this with Commissioner Arnold later. The European Defence Spending is something that even a safe amount could achieve a lot more if it's done more efficiently. I'm sure we'll talk about it later. We're out of time. We're going to hear in 20 minutes from Stephanie again. I'm looking forward to that. But do enjoy coffee and pastries for a little while. I'll see you back here in 20 minutes. Thank you very much, and thank you to my panel. Very helpful.